It's happening. Not tomorrow. Not next quarter. Not maybe. It's happening now. What most people don't realize is that history doesn't knock politely. It whispers first, then it shakes the system. And today, that whisper has turned into a roar. The short squeeze has officially begun, and those who understand what this moment means will never look at money, markets, or opportunity the same way again. A short squeeze is triggered when an asset with a large number of short positions begins to rise instead of fall, creating a chain reaction that few participants initially expect. Short sellers enter the market with the belief that price weakness is inevitable. They borrow shares, sell them into the market, and plan to repurchase them later at a lower price. This strategy works only as long as price direction aligns with their assumption. The moment price begins to move upward, the entire structure of that trade is placed under stress. What looks like a small, temporary rebound to the outside observer can, under the surface, represent the first crack in a highly leveraged position. The critical factor is not the price increase itself, but the positioning behind it. When short interest is elevated, the market becomes asymmetrical. Losses for short sellers are theoretically unlimited, while gains are capped. As price rises, unrealized losses accumulate rapidly, triggering psychological pressure long before any formal margin requirement is breached. This is where the squeeze begins quietly, not with panic headlines, but with forced decision-making. The question shifts from, will the price fall? To, how much more can I afford to lose if it doesn't? Once price crosses key technical or risk thresholds, margin dynamics take control. Brokers require additional collateral to maintain short positions, and when that collateral cannot be provided, positions are forcibly closed. This is a mechanical process, not an emotional one. Shares must be bought back, regardless of price. Each forced buy reduces available supply while simultaneously increasing demand, creating a feedback loop that pushes prices higher. The very act of covering short positions becomes the fuel that accelerates the rally. Here is the hook most people miss: a short squeeze is not driven by optimism, but by constraint. It is a market event created by necessity, not confidence. Short sellers are no longer trading an idea, they are responding to risk parameters. As more participants are forced to exit, liquidity thins and price movements become increasingly violent. Small increments turn into sharp jumps, and rational valuation models temporarily lose relevance. Price is no longer discovering value, it is discovering pressure. Another overlooked dimension is time. Short sellers operate against the clock. Borrowing costs, margin requirements, and risk exposure compound daily. Even if a trader believes they are fundamentally correct, the market can remain irrational longer than their capital can remain solvent. This imbalance between conviction and capital is what transforms a normal price increase into a systemic squeeze. The longer price holds above critical levels, the more inevitable the forced unwind becomes. What makes this mechanism particularly powerful is its self-reinforcing nature. As prices rise, momentum-driven participants enter, not because they understand the underlying trade, but because price action demands attention. This secondary wave adds additional buying pressure, further tightening supply. At this stage, the original catalyst becomes irrelevant. The market is no longer reacting to news, earnings, or macroeconomic data. It is reacting to positioning, exposure, and forced compliance with risk limits. The most dangerous assumption in a short squeeze environment is believing that price must return to fair value quickly. Fair value is a long-term concept. A short squeeze operates in the short term, where liquidity, leverage, and urgency dominate. During this phase, traditional valuation metrics often fail to explain price behavior, leading unprepared participants to underestimate the magnitude and duration of the move. This underestimation is precisely what sustains the squeeze. The deeper truth is that short squeezes expose structural fragility within markets. They reveal how crowded trades, excessive leverage, and consensus thinking can turn efficiency into instability. What begins as a calculated bet against an asset can evolve into a forced retreat, not because the thesis was immediately wrong, but because the market structure could not support the risk. In this way, a short squeeze is less about winning or losing and more about understanding how pressure accumulates when too many participants stand on the same side of a trade. Leverage is the accelerant that turns ordinary market moves into extraordinary financial events. When short sellers use borrowed capital to amplify returns, they also magnify vulnerability. Leverage does not simply increase exposure, it compresses the margin for error. A small adverse price movement can translate into a disproportionately large impact on equity, and when positions are crowded, this sensitivity becomes systemic rather than individual. What appears manageable under stable conditions can rapidly become uncontrollable once volatility increases. The mechanism that enforces this reality is margin. Brokers extend leverage under strict risk frameworks designed to protect themselves first, not the trader. As prices move against a leveraged short position, the broker recalculates required collateral in real time. The moment equity falls below maintenance thresholds, a margin call is issued. This is not a suggestion, it is a demand. Capital must be injected immediately or the position will be reduced or closed. In fast-moving markets, time is a luxury few have. Delays of minutes can mean the difference between survival and forced liquidation. Here is the critical hook. Margin calls do not wait for consensus or confirmation. They are triggered by math, not belief. A trader can be correct in the long run and still be removed from the market in the short run. This is why leverage changes the nature of decision-making. It shifts control away from the trader and places it firmly in the hands of predefined risk limits. Once those limits are breached, discretion disappears. The market decides. As losses mount across multiple leverage participants, margin pressure becomes contagious. Prime brokers and clearing firms monitor aggregate exposure, not just individual accounts. When volatility spikes, risk models are adjusted upward, increasing margin requirements across the board. This creates a sudden tightening of financial conditions within the trade itself. Participants who were previously compliant are now non-compliant, not because price moved dramatically in that moment, but because the rules changed under stress. This dynamic forces additional liquidations, even among traders who believe they had sufficient buffers. The compounding effect of leverage becomes especially dangerous when liquidity thins. In a rising market driven by short covering, available shares become scarce. Forced by orders hit an increasingly shallow order book, pushing prices higher with each transaction. Higher prices mean larger, unrealized losses, which in turn trigger more margin calls. This loop feeds on itself. At this stage, the market is no longer responding to rational actors, it is responding to forced ones. Another overlooked factor is correlation. Leveraged short positions are often concentrated among similar strategies, funds, or instruments. When one position experiences stress, others tend to follow. Losses in one area reduce available capital elsewhere, forcing managers to deleverage broadly. This cross-asset pressure can turn a localized squeeze into a multi-market event. What began as a specific trade unwinds into a balance sheet problem, revealing how interconnected leverage truly is. Psychologically, leverage alters behavior long before liquidation occurs. As margin pressure builds, decision-making becomes reactive. Traders focus on survival rather than strategy. This is where discipline erodes. Positions are reduced not at optimal points, but at points of maximum stress. Ironically, these forced exits often occur near local peaks in volatility, locking in losses while accelerating the very move that caused them. The deeper implication is that leverage creates asymmetry, not just in returns, but in control. In highly leveraged environments, the market dictates outcomes through margin mechanics. Participants are not choosing to exit, they are being exited. This distinction matters because it explains why short squeezes can escalate far beyond what fundamentals justify. The event is not driven by belief, narrative, or valuation. It is driven by enforcement. In this way, leverage transforms a price increase into a structural event. It exposes the hidden cost of borrowing conviction. When margin pressure dominates, the market becomes a system of constraints rather than choices, and those constraints, once activated, move with relentless efficiency. At the heart of every short squeeze lies a severe imbalance between supply and demand, but not the kind most investors are trained to recognize. This is not a gradual shift driven by improving fundamentals or long-term optimism. It is an abrupt distortion created when demand becomes urgent and supply becomes inaccessible at the same time. The market stops behaving like a marketplace and starts behaving like a bottleneck. And when too many participants try to pass through a narrow opening at once, price becomes the only variable that can adjust. Supply in financial markets is often assumed to be fluid, but during a squeeze, that assumption breaks down. Shares that appear available on paper are, in reality, locked in long-term holdings, restricted accounts, or strategic positions unwilling to sell. When a large percentage of tradable shares are already borrowed and sold short, the effective float shrinks dramatically. This creates a hidden scarcity that remains invisible until demand suddenly accelerates. By the time the market recognizes it, the imbalance is already entrenched. Here is the critical hook: demand during a short squeeze is not optional. It is mandatory. Short sellers must buy to close positions, regardless of price. This transforms normal buying interest into a compulsory transaction stream. Unlike discretionary buyers, forced buyers cannot wait for pullbacks or better entries. Their urgency removes price sensitivity from the equation. When demand becomes inelastic and supply remains fixed, price must move aggressively to reconcile the imbalance. As prices begin to rise, long holders become increasingly reluctant to sell. This behavior further restricts supply. Instead of taking profits early, many holders recognize the structural dynamics at play and choose to wait. Each upward price move reinforces the perception that selling now may mean forfeiting future gains. This is not greed, it is strategic withholding. The market responds by tightening further, amplifying the squeeze effect. Liquidity, often misunderstood as volume, plays a decisive role here. High trading volume does not necessarily mean high liquidity. In a squeeze, transactions may be frequent, but depth is shallow. A small number of aggressive buy orders can move price significantly because there are few sellers willing to absorb them. This creates air pockets in the order book, where prices jump not because of new information, but because there is no resistance. Another overlooked dimension is the role of derivatives and synthetic exposure. Options, swaps, and other instruments can create indirect demand for the underlying asset through hedging activity. As prices rise, market makers are often required to buy shares to remain neutral, adding another layer of demand. This hedging demand is mechanical in price, driven, not analytical. It activates automatically as thresholds are crossed, further intensifying the imbalance. What makes this dynamic especially powerful is feedback. Rising prices attract attention. Attention attracts participation. Even traders with no exposure to the original short thesis enter the market, drawn by momentum and volatility. Their buying is not informed by supply constraints, but it adds to demand nonetheless. This secondary wave compounds the problem, pushing prices higher while supply remains structurally constrained. The most dangerous mistake is assuming that supply will naturally reappear as prices rise. In theory, higher prices should encourage selling. In practice, during a squeeze, higher prices validate the decision to hold. Sellers do not emerge gradually, they emerge suddenly, often only after the squeeze has exhausted itself. Until then, the imbalance persists, sustained by fear on one side and patience on the other. This is why traditional valuation anchors fail in these moments. Supply-demand imbalances do not resolve at fair value, they resolve at points of maximum stress. Price overshoots because it must. The market is not negotiating value, it is rationing scarcity. Every incremental buyer competes for fewer available shares, and the only mechanism to allocate them is price escalation. In this environment, price becomes a messenger, not a measure. It signals pressure, not worth. Understanding this distinction is essential because it explains why squeezes can reach levels that appear irrational in hindsight. They are not irrational in structure. They are the logical outcome of constrained supply meeting unavoidable demand in a system built to clear at any cost. Market sentiment is often described as a soft, emotional factor, but during a short squeeze it becomes a hard driver of price action. The transition is subtle at first. Skepticism dominates the early stages, with many participants dismissing the initial move as a temporary anomaly. This disbelief is not accidental, it is rooted in prior narratives, valuation models, and consensus expectations. When price begins to rise against those expectations, the market does not immediately adapt. It resists. And that resistance is precisely what allows momentum to build beneath the surface. The first shift in sentiment occurs quietly, almost invisibly. Short sellers begin to question timing rather than thesis. Long holders gain confidence not because fundamentals have changed, but because price behavior is confirming their positioning. This divergence in perception creates tension. The market becomes emotionally polarized, with each side interpreting the same data through opposing lenses. This is the hook. Most overlooked sentiment does not flip all at once. It fractures first. As price continues to advance, skepticism gives way to discomfort. Short sellers experience cognitive pressure as losses accumulate. The narrative moves from, "this shouldn't be happening," to, "this is happening faster than expected." This internal shift matters because it alters behavior. Positions are reduced defensively. Risk limits are tightened. Hedging activity increases. Each of these actions adds incremental buying pressure, even before full capitulation occurs. Sentiment begins to leak into mechanics. On the long side, confidence evolves into conviction. Early buyers feel validated, and their willingness to sell diminishes. New participants, observing persistent strength, reinterpret the narrative. What was once considered overvalued is now seen as misunderstood. Momentum becomes self-justifying. Price strength is no longer questioned, it is explained after the fact. This retroactive reasoning accelerates sentiment change, pulling in capital that was previously on the sidelines. Fear, often associated with market declines, plays an equally powerful role on the upside. Fear of missing out replaces fear of loss. This emotion compresses decision-making timelines. Investors act not because they have completed analysis, but because delay feels costly. In a squeeze environment, this urgency magnifies demand at precisely the moment supply is most constrained. The market's emotional center of gravity shifts from caution to compulsion. The critical inflection point occurs when sentiment crosses from doubt into acceptance. This is when bearish narratives lose authority. Analysts revise targets. Commentators change tone. What was once dismissed becomes normalized. This transition is dangerous because it often coincides with peak momentum. By the time the majority accepts the move, the structural drivers that initiated it may already be nearing exhaustion. Yet sentiment, now fully engaged, continues to push price forward. Another layer of complexity is social reinforcement. In modern markets, sentiment spreads rapidly through digital channels. Collective interpretation amplifies individual reactions. Confirmation bias thrives as participants selectively consume information that supports prevailing price action. This echo effect strengthens momentum, making reversals less likely in the short term. Sentiment becomes sticky, resistant to contradictory signals. What makes sentiment shifts so powerful during a short squeeze is their interaction with positioning. Unlike fundamental ratings, which occur gradually, sentiment-driven momentum feeds directly into forced behavior. Each emotional reaction triggers mechanical responses, from stop losses to margin calls. The line between psychology and structure blurs. The market becomes a feedback system where belief and obligation reinforce each other. The most overlooked aspect is that sentiment does not peak at optimism, it peaks at certainty. When participants stop questioning the move, risk awareness declines. This is not a moral judgment, it is a structural observation. Markets do not reverse because sentiment is positive, but because it becomes one-sided. Understanding this progression is essential because it reveals why squeezes can persist longer than expected and end more abruptly than imagined. In this environment, price action is not just a reflection of value or liquidity, but of collective psychology under pressure. Sentiment transforms from background noise into a primary driver, reshaping behavior across the market. Those who recognize this shift early see momentum forming. Those who recognize it late experience it as inevitability. Systemic risk exposure is the point where a localized market event stops being isolated and starts revealing the fragility of the broader financial structure. At first glance, a short squeeze may appear contained within a single stock or sector, but beneath the surface, interconnected balance sheets begin to absorb stress. Financial markets are not a collection of independent actors, they are a network. When pressure builds in one node, it travels along invisible links, testing the resilience of the entire system. The initial hook lies here. Risk is rarely where it appears. When multiple institutions hold similar short positions, often through correlated strategies or shared benchmarks, losses do not remain siloed. Prime brokers, clearinghouses, and liquidity providers are exposed to the same directional risk through financing arrangements. As prices rise rapidly, these intermediaries reassess counterparty exposure in real time. Their priority is not market stability, but solvency. This recalibration can tighten funding conditions across the system almost instantly. Margin requirements are one of the first transmission channels. When volatility spikes, risk models respond mechanically by increasing required collateral. This does not only affect those directly involved in the squeezed asset. Funds holding unrelated positions may face higher margin demands simply because their overall risk profile has changed. Capital that was allocated elsewhere must now be redirected to meet obligations, forcing deleveraging across portfolios. What began as a single trade problem evolves into a balance sheet problem. Liquidity stress is another critical layer. In normal conditions, markets rely on intermediaries to absorb flows and provide continuity. During a squeeze, these intermediaries become risk-averse. Bid-ask spreads widen. Inventory limits are reduced, and market-making activity becomes selective. Liquidity, which is often assumed to be constant, becomes conditional. The absence of depth magnifies price moves, increasing mark-to-market losses and further escalating systemic stress. Here is the often ignored hook. Systemic risk does not require failure to cause damage. The mere possibility of instability alters behavior. Institutions preemptively reduce exposure, cut leverage, and raise cash. These defensive actions, taken simultaneously by many participants, amplify volatility and suppress liquidity. The system tightens not because it is broken, but because it fears breaking. Interconnected derivatives add another dimension. Total return swaps, options, and structured products can obscure true exposure, making it difficult to assess where risk actually resides. When prices move aggressively, hedging requirements force rapid adjustments. These adjustments translate into real transactions in the underlying market, adding pressure precisely when conditions are most fragile. The complexity of these instruments means that stress often emerges in unexpected places, catching participants off guard. Confidence plays a decisive role at this stage. Financial systems are built on trust in counterparties and infrastructure. When a squeeze exposes concentrated risk, that trust is tested. Even solvent institutions may face scrutiny if their exposure is unclear. Funding costs rise. Credit lines are reassessed. The system begins to price uncertainty, and uncertainty is expensive. This repricing can occur faster than any regulatory or institutional response. What makes systemic exposure particularly dangerous is speed. Modern markets operate on compressed timelines. Automated risk controls, algorithmic trading, and real-time reporting accelerate both recognition and reaction. There is little room for gradual adjustment. Once thresholds are crossed, responses cascade. The system does not pause to evaluate fairness or fundamentals. It enforces rules designed for survival. The deeper implication is that short squeezes act as stress tests. They reveal how much leverage the system can tolerate, how concentrated positioning has become, and how quickly confidence can shift. These events expose the trade-offs between efficiency and resilience. A system optimized for maximum return under normal conditions often proves brittle under stress. In this environment, systemic risk is not an abstract concept, but a lived reality expressed through funding strains, liquidity gaps, and rapid behavioral shifts. The squeeze becomes a mirror, reflecting vulnerabilities that were always present, but rarely visible. Understanding this exposure is not about predicting collapse, but about recognizing how tightly coupled modern financial markets truly are, and how quickly localized pressure can evolve into systemic consequence. Extreme volatility is the defining characteristic of a short squeeze, and it is the environment where disciplined risk management separates survival from destruction. Price movements in these conditions are not incremental, they are discontinuous. Gaps replace trends, and reversals occur without warning. Traditional expectations about orderly markets no longer apply. What appears as opportunity on a chart may, in reality, be exposure to uncontrolled risk. The first and most important hook is this: volatility is not danger by itself, but unmanaged volatility is. Risk management in a squeeze is not about prediction, it is about preparation. No participant, regardless of experience, can consistently forecast the precise path of price under forced buying conditions. The only controllable variables are position size, leverage, and exit discipline. When volatility expands, the same position that was tolerable in calm markets can become catastrophic. Professionals respond by reducing exposure, not increasing conviction. They recognize that capital preservation is the prerequisite for participation. Timing becomes deceptive in high volatility environments. Rapid price acceleration creates the illusion of missed opportunity, pulling participants into late entries with unfavorable risk-reward profiles. This is where emotion overrides structure. The market rewards speed, but punishes haste. Entering without defined risk limits transforms speculation into gambling. The hook most traders learn too late is that being early is optional, but being wrong at scale is fatal. Position sizing is the silent anchor of stability. Smaller positions provide flexibility. They allow traders to absorb adverse moves without triggering forced exits. In contrast, oversized positions magnify stress and compress decision-making time. Under extreme volatility, even correct directional calls can result in losses if position size is misaligned with price behavior. Professionals think in terms of survivability, not maximization. Liquidity risk compounds this challenge. During a squeeze, the ability to exit a position at a desired price cannot be assumed. Stop-loss orders may be skipped. Slippage becomes the norm. This reality forces a shift in mindset. Exits must be planned with the expectation of imperfect execution. Risk parameters must account not only for price movement, but for market conditions under stress. Ignoring this is equivalent to assuming the door will always be open during a fire. Another critical dimension is asymmetry. Short squeezes create environments where upside and downside risks are uneven. For shorts, losses are theoretically unlimited. For longs, gains can evaporate rapidly once forced buying subsides. Risk management is about recognizing where asymmetry lies at each stage of the event. What was once a favorable setup can quickly invert. Adaptation, not loyalty to a thesis, becomes the primary skill. Psychological discipline is inseparable from technical control. Volatility amplifies emotion, distorting perception of risk and reward. Fear and euphoria coexist, often within the same trading session. Professionals rely on pre-defined rules to counteract these impulses. They decide exits before entering positions. They accept missed gains as the cost of survival. The hook here is uncomfortable, but the market does not reward emotional endurance. It rewards emotional restraint. Time horizon also matters. High volatility compresses time, making short-term outcomes dominate attention. Long-term strategies become vulnerable to short-term shocks. Risk management requires alignment between strategy and market regime. Holding positions designed for stability in a regime defined by instability invites unnecessary exposure. Adjusting timeframes is not an admission of error, it is an acknowledgement of reality. What ultimately defines effective risk management in a short squeeze is humility. The recognition that control is limited, information is incomplete, and outcomes are probabilistic. Volatility exposes the cost of arrogance quickly and without apology. Those who respect risk stay adaptable. Those who underestimate it become examples. In these conditions, discipline is not restrictive, it is liberating. It provides the structure needed to operate when markets abandon structure. Volatility will always be present in squeezes, but its impact depends entirely on how risk is measured, sized, and respected. So remember this moment, not because of the headlines, not because of the hype, but because this is what transformation looks like in real time. When the crowd panics, stay grounded. When pressure builds, stay disciplined. And when opportunity appears disguised as chaos, be ready. Because history is being written right now. And the question is simple. Will you watch it happen? Or will you understand it while it does? The short squeeze has begun, and those who stay sharp, stay patient, and stay informed will never forget what this moment taught them.